Alibaba just dropped an earnings report that sent Wall Street into panic. And the stock is paying the price. After a massive start to 2026, BABA has plummeted over 30% from its recent highs, and we are now trading dangerously close to a major technical support line, the $120 mark. If you just read the headlines, it looks like a disaster. A massive profitability slump, a brutal price war in food delivery, and across the board misses on revenue and earnings estimates. But if you look under the hood, you'll find a cloud business that is accelerating and at an incredible pace. AI revenues printing triple-digit growth for the 10th straight quarter, and a bold strategy that could double cloud revenues in the coming years. Is Alibaba burning cash, or are they building the ultimate technological moat in China? Today on MoneyJourney, we are dissecting the good, the bad and the ugly of BABA's latest numbers. If you want to master the markets and find real value behind the headlines, hit that subscribe button right now and let's dive in. Let's stare into these December 2025 quarter numbers, because there is a massive tug of war happening inside Alibaba right now. First, the top line. Total revenue came in at roughly $40.7 billion US dollar. That's an increase of 2% year over year. But if we strip out the disposed business of SunArt and InTime, revenue on a like-for-like basis actually grew by 9%. Not bad, right? But it is where investors hit the sell button. Income from operations cratered by 74% and adjusted EBITDA plunged 57%. Net income took a 66% nosedive year over year. Why is one of the biggest cash printing machines in China suddenly bleeding margins? The answer is aggressive, calculated warfare. Chief Financial Officer Toby Xu made it very clear. Alibaba is using its massive liquidity position to scale investments aggressively. They are throwing billions into quick commerce to fight the brutal price war, enhancing user experiences, and most important, funding their full stack AI and cloud capabilities. And that brings us to the silver lining, the part of the report that shows exactly what CEO EDU is building. The Cloud Intelligence Group is on absolutely fire. Revenue here didn't just grow, it surged 36% year over year. Even better, revenue from external customers grew 35%, a significant acceleration from the 29% we saw last quarter. But the real star of the show is AI. For the 10th consecutive quarter, AI-related product revenue delivered triple-digit growth. Let that sink in. 10 quarters of over 100% growth. Alibaba's proprietary model as a service platform is becoming the new engine for this company. On the consumer side, they integrated their AI into the Qwen app, which just blasted past 300 million monthly active users. Wall Street is punishing Alibaba for the short-term margin compression, but the internal metrics show a company that is willingly sacrificing today's profits to dominate tomorrow's cloud and AI landscape. Does this look similar to other companies? Yes, Amazon has been doing the same for years, creating plenty of value for their shareholders. With management hinting at potential price hikes in cloud service in the coming quarters, we could be looking at a major catalyst for margin recovery much sooner than the market expects. So, what does this mean for the future of Alibaba? We have to zoom out and look at the macro picture. Right now, we are looking at a classic transition phase. Alibaba is pivoting from being a pure-play e-commerce giant into a foundational technology infrastructure company. Make no mistake, Alibaba is positioning itself as the undisputed biggest AI company in China by deeply integrating their foundational models and proprietary chips into both enterprise and consumer ecosystem. Yes, they are building chips as well. They are building a walled garden of efficiency. If they succeed, the future revenue and profitability will just recover. They will multiply. Think of what AWS did for Amazon's margins over the last decade. but supercharged by the AI revolution. China is uniquely positioned to adopt AI at an unprecedented scale due to its massive manufacturing base and digital-first consumer economy. If there is one country that is capable of competing with the US in AI, it is China, definitely. If Alibaba's gamble pay off, they won't just compete in China. They will be a formidable player on the global stage, offering enterprise AI solutions that rivals Western tech giants. For investors buying at these depressed levels, the upside is massive. Basically, Alibaba is the cheapest AI play in the market right now. You are essentially buying a world-class cloud and AI business at a steep discount with a legacy e-commerce business thrown in for free. If this happens, we'll see a massive re-rating in Alibaba valuation. We'll see fundamentals improving and profitability return to healthy margin, even better than before. But it will take time and investors need to be patient. But as investors, we must weigh the risks. What if this heavy investment into AI turns out to be a disappointment? What if the monetization of the Qwen app stalls or enterprise customers bulk of future price hikes? If the AI thesis cracks, Alibaba will have permanently degraded its operating margin for nothing. The price war in quick commerce will have eaten into their cash pile, leaving them fighting a two-front war with diminished resources. The next 12 to 18 months are critical. They must prove that these investments yield tangible bottom line returns. The good news is Alibaba is a very diversified business and their future doesn't depend only on AI. If AI investments do not yield the expected return, they could switch fast and focus on other segments and still be a great and very profitable business. Management has been doing an incredible job in my opinion, and as a Baba investor, they have my trust. During the last 4 years, they showed resilience, doing a lot of share buybacks when the stock price was incredibly undervalued, creating a lot of value for Baba investors. The paradigm has shifted, and now management believes that money is better invested in their cloud and AI business, and I trust them in this decision. Valuation remains very attractive at this price. If cloud continues to perform like investors and analysts are expecting, their cloud segment could be worth more in 2 or 3 years than the entire Alibaba business is valued right now. This is the kind of upside that we like to invest in. To wrap this up, Alibaba is a company in the middle of a massive, expensive, but potentially historic transformation. We have an incredible core businesses with accelerating cloud revenue weighed down by the heavy cost of securing the future. Yes, there is a lot of macro and operational uncertainty, but let's look at the valuation. The stock is priced right now as if investors are expecting absolutely nothing from this company. The pessimism is baked in, which often creates the most asymmetric risk-reward opportunities in the market. What do you think? Is Alibaba's massive spending a genius move to secure AI dominance, or are they burning cash in a race to the bottom? Let me know your thoughts in the comments below. And if you found this analysis valuable, make sure to subscribe to the MoneyJourney channel so you never miss a market breakdown. If you want to know more about Alibaba, their fundamentals and valuation, please click on this link and I'll see you in the next video.